Greetings, my name is Christopher Bell. I'm a certified public accountant. This is this picture of me if you're wondering what I look like. In this video, we're going to talk about retained earnings. What is it? How do you increase it? How do you decrease it? What's the process? Retained earnings is very, very misunderstood because I think a lot of people think it's just cash. Whatever, how much cash you have on your balance sheet is your retained earnings. That is 100% fallacious. Your retained earnings is simply your company's accumulated earnings that have not yet been distributed to shareholders. Now, what would a distribution to a shareholder be? That would be a dividend. So to calculate retained earnings, at least on a year-over-year basis, we have this very simple formula here. Very, very, very simple formula. We have the beginning period's retained earnings plus the net income minus the cash dividend minus stock dividends equals ending retained earnings. It's as simple as that. Now, where do you find all this stuff? Well, I've got a couple examples here, okay? So, first of all, net income. Where do you find net income? Because to solve this formula, you got to know where net income is. Well, you have to go look at the income statement, okay? You got this is a multi-step income statement. At the very bottom, you're going to see this number called net income. This is the bottom line profit and loss. So theoretically, these are the earnings that the company can distribute out to the shareholders. This is the business's profit for the period shown. What happens every year is this net income gets closed into retained earnings, which I will cover in another video because it's a long process. But it gets closed into retained earnings. So it goes from the net income to the balance sheet to this account retained earnings. Now, keep in mind, these are two different companies. Obviously, retained earnings would be a lot higher. Well, I mean, I guess not, but it would be a lot higher if a company was making this much profit and not really paying any dividends. So it goes from here, it goes from the income statement every year, and it gets closed into retained earnings right here. Now, if you want to see the change in retained earnings, if you want a cheat sheet, you can actually go to what's called a statement of stockholders' equity. Companies have this. And you can see how retained earnings has changed. Now we can see they have a beginning balance of $11 million. They increase it with net income. So your accumulated profit and loss goes up, and you subtract out cash dividends and stock dividends to arrive at ending retained earnings. It's as simple as that. You don't need to overcomplicate how retained earnings works. Now, if we go back to the balance sheet, we can obviously see that stockholders' equity is composed of more than just retained earnings. There's also capital stock here. We can see that this company has $192 million of cash. Now, could this company, even though it's had accumulated earnings of $480,000 that they have not distributed yet to shareholders, can they actually pay that all out right now? Well, I guess they could make distributions of land and building. I guess they could do that, but they definitely can't pay a cash dividend of $480,000. So you have to understand that just because you have a retained earnings doesn't mean that the company can automatically distribute that. A lot of that has been reinvested, retained in the business. That's why it's called retained earnings. And it's been used to buy other things. Maybe it was used to buy the land. Maybe it was used to buy the buildings. Maybe it was used to buy inventory. It could have been used for a ton of things. But that's the concept behind retained earnings. So if you write it out every time, if you memorize this formula, it's really not hard. Beginning retained earnings plus net income minus cash dividend minus stock dividends equals ending retained earnings. Simple as that. Hope you learned something. Talk to you later.